All right, we've got Richard Alexander, who is with Arnold and Porter. He is just recently retired from being the managing partner at Arnold and Porter. All right, then we've got John Cort, EVP and General Counsel of the Bank Policy Institute. Paul Saltzman, down at the end there, Chief Legal Officer, EagleBank. Paul's been in very many incarnations. Some of you may know him from the New York Clearinghouse. And Meg, partner and head of financial institutions at Davis Polk. So, JP, why don't you start off this panel of experts on financial regulation?
Well, thanks for inviting me. It's a pleasure to be here. Nice to see all of you here. Yeah, I think the question of the competition between banks and non-banks, the shadow banking sector has obviously been around for a very long time. We've seen different iterations of it sort of rise and fall over the years. I think from a policy perspective, I think there's always been concern about sort of performing the same activity but under a different regulatory and legal framework. We have a comprehensive legal and regulatory and supervisory framework for a whole host of activities that you see inside the banking system. All these activities are theoretically inside the regulatory perimeter. And over the years, we've developed this framework, starting back in the 1860s for a national banking system. We're watching that go through panics, the establishment of the Federal Reserve System in 1913, establishment of a deposit insurance and a comprehensive framework for the capital markets and the securities markets from an investor protection standpoint, the Bank Holding Company Act in the 50s, and revision. So we've seen all this. Largely, this framework has been built up like in response to developments in the marketplace. It's generally like a free marketplace, but when problems arose, the government decided that they needed some framework to help govern those risks, right? To protect financial stability, to promote lending to the economy, to protect consumers. So we've seen all that. It's a comprehensive framework. It's generally a framework that applies to bank holding companies. There are some trading houses that operate outside of that. And there's cost associated with it, right? It's not free, but we have collectively decided as a country that the costs are worth the benefits, right? And we can and should revisit that from time to time, right? It's very smart. I think we're in a period where we're doing that right now. So that's generally what we have. And then there are lots of people who want to make money in this country, who look at all the revenues that are within that regulatory perimeter, and they think, well, that's crazy. I can do that activity for cheaper. I won't become a bank or a bank holding company. I won't operate inside the regulatory perimeter. I'll just provide that product or service or that activity outside of the perimeter. I will be careful that I don't trigger any of the legal thresholds that would put me in the perimeter, and it's great. And I'll compete and I'll provide that service, and I won't have the cost burden of the framework. And so that's fine. So that's what we've largely seen. That's the shadow banking system, right? And from time to time, it sort of blows up and explodes, and people have to put out the fires. So I think that's what's happening now. So you ask, like, what should we do? You got big tech, fintech, crypto, all wanting to come in and provide financial services and products to businesses and consumers. And I think the question is simply like, we should welcome that, right? Competition is good, right? If we have a cost framework that like is too cumbersome and people are paying too much for products and services, like we should look at that and see if we can make that better. But we should do it in like a principled way. We should not be stupid about it. We've been stupid about it in the past. And as a general matter, I think we should look at like same activity, same risk, same regulation, right? And if you have an activity and you have a risk and you don't like the regulation, then we should change the regulation. But we should not create these massive arbitrage opportunities for people to come in and do things that then blow up and hurt people or destabilize the financial system. And then we say to ourselves, oh, yes, of course, same risk, same activity, we should have regulated it the same way. So I think that is our that's a BPI principled approach to a lot of these issues.
So looking at the last 2 centuries, and the 10 financial crises that we've had in this country, which, by the way, are more than any other country in the world with Argentina, right? We've got the most sophisticated, comprehensive regulatory system. We've had more financial crises in this country than any country but Argentina, so figure that one out. But in every one of those crises, asymmetrical regulation, which is what you're talking about, the arbitrage, played a role in what happened in the marketplace. So let's just remember that throughout the day as we talk about the future of regulation. But Meg, I want to ask you a question. What are the things that I sort of reflect on now after 50 years of practicing law? And the funny thing is, you only get to reflect after you're finished, right? Because you're too busy, every day. And one of the things that I really appreciate is having worked with some of the greatest financial minds in this country and having represented them and people in some great stuff. And when I look back, I said, holy cow, I learned so much from being there. And I have all these great insights, which nobody cares about anymore. But let me ask you, if you could fix a few things in the regulatory system today from your perspective, what would they be?
So I've got a magic wand. I don't have to be sensible. I can just have whatever fantasy I'd like to have.
Right.
So I'm going to build on John's same risk, same activity, same regulation and supervision. The first thing is, why the heck do we have 4 bank supervision and examiners at the federal level in this country? We don't need that many. Why do we have a CFTC and an SEC? I know that many like to have the regulatory arbitrage of saying, I'd like to switch charters, but I think there's ways to keep the dual banking system while at the same time doing massive consolidation at the federal level. So that's one of the things that we have. If you go back and look at the crises, it's very interesting because many of our crises were in the 19th century when we were the only
Right.
country without a lender of last resort.
Right.
So I think some of the things we should be looking at and saying to ourselves, we are the only country that does X. Because I do wonder if you took out the 19th century and just started from Federal Reserve on, where we would be in the number of financial crises.
Yeah, we actually have less, but they're bigger.
Okay, but our economy is bigger. So the first thing I would do is that. The second thing I would do as part of that consolidation is I would have one cadre of banking supervisors, not FDIC, OCC, CFPB, Federal Reserve, NCOA. I'd have one cadre, similar training, and I'd make their training public and I'd make it transparent. You know more about the qualifications of your barber and your manicurist than you know about the training of the supervisory staff at the federal level. And that's just crazy. So I would make that one hierarchy, one salary scale, more career advancement possibilities moving across, and transparent curriculum plus continuing education requirements. I'll close by asking the question, what training and education did recent examination staff have on interest rate risk the last 10 years? We don't know the answer to that question in this room, and it's kind of absurd that we don't. So I'll stop there. I have many more fantasies, but time to share the mic with others.
Following on to Meg's points, Richard, what is the one thing in the examination context that has continually challenged clients and could be improved by the agencies?
Okay, and despite my youthful appearance, I've been doing this for 40 plus years. So
You started when you were 12, right?
I started when I was 12. So I'm going to be a little more granular and talk a little bit about the experience of financial services companies, and I'm sure Paul will have some things to add. And I'm going to ask your indulgence. I'm going to do 2 things, not one. So thing one is that our regulatory apparatus has corporate governance on upside down. Boards of directors do not run banks. Boards of directors do not insure anything. Boards of directors do not implement anything. Boards of directors provide oversight. And if you look at the examination process for, since I started the OCC in '82, and I don't think it's really changed, particularly when things get tough with institutions, the focus on the role of the board versus the role of management is upside down from a corporate governance standpoint, and I don't think it serves the supervisory interests of the country or of the industry. So that's one thing. By the way, I'm being critical about that. I also think there's some things that are going on, and we'll talk about later, that are some real improvements that are going on in supervision that we should highlight. The second thing that I think is really, really important is what I'll call the recency of the examination process. It is a long, drawn-out process. It is very common for clients of ours to have an examination that they're dealing with at the board level, at the management level, that started a year before, using financial data from maybe 18 months before. And if something good happens during that examination process, banks have been responsive, proactive in dealing with financial conditions improve. Regulators say, no, it's outside the scope of the exam. If bad things happen, oh, they pile on. So with all the technology we have in the world and supervision, the fact that these exams take so long, they are so dated, they do not reflect the current situation. And then to pile on with that, if in fact, and I come from a problem bank perspective, then they come in with a remedial course of action, which is also antiquated. You're talking about antiquated supervision. It's an antiquated process where they're asking us to solve problems and to put together a lot of paper and a lot of costs and expense that tend to be backward-looking rather than forward-looking. So those are two things. I'd really focus on the role of boards versus management. We want to encourage good board members to come on financial institutions, but not to run the institution. There's not enough insurance and not enough director's fees to do that. And we need to make the examination process more nimble in terms of, kind of the latency that exists within the supervisory process.
JP, I'm going to go a little out of character here and maybe provide a slightly different perspective, Richard, on the governance point, which is, now having worked at EagleBank for 6 years, been in myriad, as folks know, of financial institutions, there's nothing like a regulator addressing something to the board to get their attention. And I'm not saying that boards generally don't have the capacity or the wherewithal to properly oversee, but I'm not so sure that, and I understand at a micro level, John knows from our days at the clearinghouse, there's too many prescriptive directives, but I'm not so sure holding boards accountable for heightened oversight and making sure that the regulatory community sort of directs things to the boards. Generally, I found that it's a good thing. It kind of really gets their attention. It makes them focus where they might not otherwise focus on the risk and the regulation as opposed to pure profit. So I take your point, but directionally, there is a benefit to having sort of the board's feet held to the fire.
And I think actually we're agreeing, because you use the word oversight. And as long as it's couched in terms of oversight, I don't think your board members are developing policies and procedures. They're demanding of management that they're being responsive. And so I think the communication about what needs to be done is appropriately directed at the board. And one of the things I applaud what the agencies are doing is sharpening the matters requiring board's attention. I think that will help. But in terms of the execution of the things that are being directed, that is a management staff function, and this has been going on forever. I think it's turned upside down. So I think we're actually in agreement.
Fair enough.
Paul, let me stay with you for a second, because you've got a unique set of experiences. You've been with the largest banks in the country at the New York Clearinghouse. Now you're running a community bank, a local with $10 billion in assets. So you've got that wide perspective. And by the way, with respect to the Clearinghouse, I recommend everybody just read about the history of the Clearinghouse, because in 1907, when the financial system in this country was falling apart, the Clearinghouse played the role of the FDIC, which eventually then became the model for the FDIC, but that's neither here nor there. I want to get your perspective on what should be modernized in our financial system.
Thanks very much. Appreciate GMU for having me. It's an honor to be here. It's also an honor for EagleBank. We've been longtime supporters of GMU. Next year, we need to have it at the EagleBank Arena, perhaps,
Yeah, right.
and have 15,000 people in the audience. You also know you're sort of getting old when your protege starts, serving on panels with you. So, and I think the last sort of a bit of laughter is I personify where you stand depends on where you sit. So everything I say today will be diametrically opposed to all my positions when I was running the clearinghouse. But in any event, I think the first thing is thank you for bringing the community bank perspective to the table. And I think there's something that we can all agree, which is community banks play a critical role in our nation's economy and are an important part of the mosaic of the banking system. JP Morgan is not, producing a $10 million line of credit to a Bethesda restaurant, right? And absent community banks all across this country, citizens and small businesses would simply not be getting the banking services and the credit availability. So I think if you start from that premise, you need to pay more than just lip service to that premise, and you need to recognize that everything that we're talking about is just simply more impactful to community banks. 10 basis points of additional funding costs on $1 billion of deposits is $10 million, right? We shut down our residential mortgage business because of the compliance costs associated with that. Now it's a very competitive market and maybe folks continue to be served, but everything is just simply more impactful. The cost of regulation is more impactful. The cost of funding is sort of more impactful. So a couple of issues in terms of, I think, where Eagle and many of the community banks sort of sit. So first of all, it's not just the shadow banking system. I think there's been and Meg could talk about this, and I know there's more panels, a devaluation of the banking license, right? And for community banks, if you start to introduce trust companies and give non-bank access to the payment system or create forms of special accounts, you're devaluing the charter that is critical to a community bank franchise. If you start to pay yields on stablecoins, what kind of deposit outflow and disintermediation are you going to have from that? And again, if JP Morgan loses $10 billion in deposits, who cares? If EagleBank loses $500 million in deposits, it's an issue. So again, the law of numbers simply means that these issues are more critical and more important for community banks. Supervision is really the binding constraint, I would say, more than regulation. Most community banks, notwithstanding the great trade associations that we have, are price takers. We're not going to influence the overall regulatory environment, but supervision matters, so we applaud Governor Bowman's efforts to have a risk-based approach. Horizontal reviews, we're not big fans of, because I think the other big problem, John and I, we've labored for many years over this, which is you end up having certain institutions that have the ability and funds to develop practices that then get trickled down. I could tell you from firsthand experience in the AML BSA space, in technology, where regulators have said you should be doing something a certain way because that's the way your peers or that's the way the big banks do it. So I think a better recognition of the fiscal constraints that smaller community bank, and we're sort of a regional bank in a way. You have many banks that are under 5 billion that don't have the sort of resources that we have. I would say the $10 billion threshold is arbitrary. When I came to Eagle, we were just crossing the $10 billion threshold. And for those of you who don't know, 10 billion is a critical sort of Rubicon for enhanced or heightened risk. We're now 11. So we're kind of in a little bit of a no man's land, but that's intentional for us strategically. But I think a more tailored approach, going back to your conceptual framework, John, which is it should be very risk-based, not necessarily triggered based on size. You could have a small institution that is engaging in risky activities that is exponentially riskier to the system and to itself than a $20 billion bank, or like Eagle. We're a commercial bank. We take deposits, we make loans. Nothing terribly sort of complex about that. And then lastly, I'll just say an area that's absolutely critical, and this is an area where John and I probably disagree, and that's deposit reform. There is absolutely no question that there is a too big to fail implied subsidy. When I was running the clearinghouse, I obviously opposed breaking up the big banks. I'm not suggesting that big banks need to be broken up, but we now have empirical data, certainly after Silicon Valley Bank. You saw massive outflow for no reason other than perceptions of safety and soundness. You have advanced broker markets now where you can price the differential between core deposits and broker deposits. You have IntraFi, I see Diane, good friend in the audience, and other reciprocal brokerage operations cost 10 basis points, 12 basis points. And we went from Eagle, just to use our example, we were a victim of that, maybe I think the fourth, fifth largest deposit outflow. We gained it all back. We went to IntraFi. We've brought down our uninsured deposits now to less than 24% of our total deposits, which is industry leading. But it cost us 12 basis points, right? So I think deposit reform is an issue, and forgetting about the politics and where you draw the line, but targeted deposit reform, focus on business accounts, custody accounts, and then we were at dinner and we were talking, well, are you going to want to pay the deposit insurance premium? I'm paying anyway, right? So I'm not suggesting that the community banks want a free lunch for this additional insurance, but as I said earlier, deposit outflow is a more meaningful and risky situation for many of these community banks. So that's just a laundry list conceptually of some of these things, and welcome continuing the dialogue.
I want to just comment for a moment on deposit insurance reform because I think it's gotten more traction on the Hill than it has had in a number of years, partly because of the empirical evidence, but it's kind of a little bit been stalled because for a number of reasons, which include the fact that the banking sector itself is very much divided, and divided not necessarily along classic lines. I haven't understood why the concept of deposit insurance reform really needed most for the mid-sized banks between 10 and about 250 hasn't been linked to the stablecoin yield discussion. And for some reason, that hasn't been leaked. Now, none of us know where stablecoin's going to go. I do think that the stablecoin sector and the crypto sector, they've got what they have now in the law. It's not a bill, it's a law. And so that's essentially something they already have. I know, some people far above my pay grade are out there doing a deal that I'm not gonna, I don't know what it is. But I do think linking these two makes a lot of sense, and I think if we don't want to move immediately to a barbell, then we're going to have some kind of sensible, targeted deposit insurance reform that also fairly allocates who pays what.
JP, you had another question?
Well, can I just jump in on the deposit insurance thing, which is a very important topic, and Paul, I don't think certainly at BPI, we don't oppose deposit insurance reform. We have no position on deposit insurance reform, and that just is an honest reflection of the fact that we just don't have consensus amongst the BPI members, which are generally banks over 100 billion, on what should happen. I think there have been proposals that were advanced very quickly that sort of fell flat, and I think those proposals weren't very well thought out, they weren't very rational, they weren't grounded in data and analysis. It was all politics and political theater, and it just didn't work. The FDIC has taken a very thoughtful approach to what deposit insurance reform could look like. I think they put out a report maybe a little after SVB. I think they had 4 general recommendations, none of which...
They didn't make recommendations. They just said, here's an option, here's an option, here's an option, but they didn't say which one they
I presume they selected the options that they thought were the most sensible. But yes, so not recommendations. So I think, yeah, I agree with you. And I think the deposit funding for banks in this country is probably going to experience a little bit of turmoil going forward, particularly when you talk about AI and agentic AI and AI agents on behalf of treasurers. So large corporate treasurers are already very sophisticated. But when you think of smaller corporate treasurers or small businesses like when it comes to managing their cash, they just kind of keep it at the bank, right? They need to keep it at the bank. They have a relationship with the bank. They keep the deposits at the bank. It's very good for the bank. It's good funding. The bank can then turn around and make loans. This is a good model that drives economic growth throughout this country, in rural areas, small towns, and larger cities. But when these treasurers, it's like there's some laziness associated with that, right? They just don't have the time and the attention to be allocating their extra cash resources to the highest yielding thing. When an AI agent will be able to do that for them, I think there will be some disruption, right? And they'll say, you really shouldn't keep 5 million here. You should keep 400,000 here based on our analysis of your last 36 months of what your cash needs. And really, we should move some of it into higher yielding. There's just going to be deposit volatility. So trying to stabilize that, and if deposit insurance reform is one way to do that, I think that probably makes a lot of sense. It should just be in a really thoughtful way, looking towards the future.
Thank you. John, regulators are taking steps to reform the exam process, focusing on material risk, check-the-box compliance, and governance documentation. How will this progress, and are the changes meaningful, and do you think they'll be long-term?
So again, on this exam reform issue, which is a super weedy issue, I think, but I'm glad people are paying attention. I guess the first question is just what are we talking about? What's the problem statement? Is there a problem statement? So I think there is a problem statement. The question is, do we have an efficient and effective supervisory and examination framework in this country for our banks, right? That's sort of the question. I think, certainly from a BPI perspective, I think from many banks' perspective, I think the answer is yes, but no, right? And so if you want to focus okay, well, what's the problem statement? What do we need to fix? We did a survey of our banks in 2023 and just asked a few questions what amount of your board of directors' time and attention is spent on dealing with examiners and examiner mandates and examiner requests? And we asked for the period in 2016, which was sort of the height of the Tarullo, Obama administration, sort of what many people probably thought was the top of the demands from the supervisory framework. Totally legitimate. Just 8 years after the global financial crisis, the implementation of the entire post-global financial crisis rule book, a very heightened sense of the problems that can happen when the banking system gets shaky. So in 2016, I think the numbers were maybe 30% generally. At board and senior management time, generally 30%. And then we also asked what proportion of your IT budget is allocated to doing that same thing? Again, just responding to examiner demands. And I think it was 11%. By 2023, right, so you've had the first Trump administration and you're 3 years into the Biden administration, those numbers had jumped significantly, in some cases about 60%. So boards and senior management were spending anywhere from 42 to 45% of their time dealing with examiner mandates and demands. And the IT budget spend, I think, had gone from 11% to 17%. So, it was only increasing. It increased a tremendous amount after the global financial crisis, and that makes sense. But then it just kept increasing, right? There is no natural predator on the behavior of the independent banking agencies. They just expand. They never contract. There's never a sense of this isn't working, let's pull it back. It's just growth, 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 growth. No natural predator. So the problem statement is, do we in this country want government officials, government examiners, career examiners, and by the way, these are people that have the hardest job in the world, right? No respect, no thanks. When things go wrong, we know who to blame. When things go well, you get no credit. I get it, right? But it still doesn't mean we shouldn't be asking ourselves the tough questions. So do we want our boards of directors and our senior management spending 40 to 45% of their time responding to examiner mandates? And why is that happening? It's happening because there has been this sort of move towards a check-the-box mentality. And there has been a growth of examiners demanding, not necessarily looking at the risks, but looking at the processes and the governance and the frameworks around how the risks are managed. And the documentation thing is really what got out of control, just demanding extensive documentation for every decision the bank was making. And the bank was we make decisions every day. We don't sit around document. The examiners are well, I want to see documentation. So the banks were spending just a huge amount of time building out these risk management frameworks that actually weren't reducing risk. They were just papering the decision-making around how you think about reducing risk. And it was a huge mistake, and that's the problem statement. So when this administration came in, the agency principals that this administration put in charge were very committed to addressing that problem. They accepted the premise of the problem, and they were committed to address it. And so the first thing they've done is they have tried to reallocate examiner attention to material financial risk. And they want to move examiner attention away from risks that are not material to the financial condition of the firm. That's just a way to try to get at it and be like, fellas, like you're in the banks, you're doing your job. Don't focus on this documentation stuff. That's a waste of time. Everybody's distracted. Focus on the real risk. The other thing I think they're trying to do is oftentimes, like, nobody actually knows what they're talking about when we have this discussion, right? If you're at a bank and you see it, you can't talk about it because that would be a violation of the confidential supervisory information rules, right? And that could be a government official could say that's a conversion of federal government property, and you're going to go to jail for discussing and disclosing what you and your examiner talk about, right? So there's a tremendous amount, because of that framework, there's just a huge amount of secrecy and opacity, right? Which is one reason like why we had done the survey. So the other thing that I think that these agency principals are committed to do is reforming that process, right? And allowing more transparency into what the examiners are doing, what the examiners are asking the banks to do. And I think that just promotes accountability, right? And there's a bunch of other things that are going on but I want to be respectful of time, and I'm sure others here will want to jump in. But I think all of these reforms are good and sensible, right? People talk about, oh, deregulation, this is terrible, like we're creating a bubble, we're gonna blow up. I don't know, maybe. But I don't think that's what they're doing. That is not their attitude going in. Their attitude going in is like, no, we're actually really trying to make it better. We understand how it got to where it was, but we think that's not the appropriate place for things to be, and they want to readjust it. And I think it makes a lot of sense. And I think it will be durable, because I think a lot of these reforms, there is a significant, serious effort to write them into regulation, right? To reduce the extent to which the examiners have a huge amount of discretion that they utilize in the shroud of secrecy.
So, Richard, you and I have worked on a lot of matters over the years, and I know you have some strong views on the things that John's talked about. But before you do, let me address one issue he raises, and that's the natural predator issue. So, 50 years ago next month, I started at the OCC, 1976, and I went back and I looked, and it takes a little time because you got to find an old copy of the CFR from 1976. But the Office of the Control of the Currency, if you eliminate the 60 pages of regulations for 12 CFR 1, which are the list of investment securities that are permissible for national banks, eliminate those. In 1976, OCC had 70 pages of regulations in the Code of Federal Regulations. 70, all right? Today, it's 1,300 pages, all right? So you talk about there not being any natural predator and how the growth continues exponentially. You get to a point where you say, wait a minute. I mean, somebody's got to take a different view about this. And it goes back, of course, to the old debate between rules-based regulation and principles-based regulation. And we have long since passed principles into the depths of rules-based regulation. So, Richard, take it from there.
Yeah, I mean, before I get into a little more granular discussion, I just want to remind everybody that all this discussion is taking place in the context of the pendulum. John, to your point, we have regulation in crisis, over-regulation in crisis. Things get better, we slim things down, we have another crisis, a new crisis. I can close my eyes. There's such commonality among these crises. The products may change, the geographic locations may change, and so that's one thing to be cautious about. The other thing is that DOGE has absolutely decimated the expertise in these regulatory agencies, and we should be concerned about that. I'm not always copacetic with the people on the other side, but we should be concerned as a country about that. So I just wanted to get a little granular on some of the stuff that John was talking about, just so that we're all level set, and I'm going to look at some notes, and I apologize for that. But so for the first time ever, the agencies have adopted or have proposed a statutory definition for unsafe or unsound. That's a huge issue, because historically it's been like pornography. You knew it when you saw it.
It was John Horn, remember?
Yeah.
His testimony.
You knew it when you saw it.
Right.
It was in the eyes of the examiner. oftentimes it was unsafe and unsound to fail to have a policy or procedure in a particular area. And that kind of thinking is going to be rejected. So they are trying to build this into a statute so that the statute survives the administration, the changes in the administration. And that definition, as John says, is focusing on financial risk. I think that,
Regulation, right, Richard, a regulation.
Yes,
It's in
building
the
it into a
statute,
reg.
Right.
Defining the statutory terms through regulation.
right. But you know, there's going to be some holes in this going forward. But you're not going to see the kind of criticism with this change. So that's really, really important. The agencies are also focusing on limiting the kinds of things that are matters requiring board attention. I think to Paul's point and John's point, it's to get the board focused on more important things. But there will be consequences, good and bad. I applaud these changes, but there will be consequences, good and bad, about resource allocation, the messaging that comes with something that's a non-binding observation versus a matter requiring attention. And a big issue is going to be, are these changes going to, you know, which are being articulated from the top, are they going to find their way to the examiners? And are the examiners across the agencies going to apply them consistently? Just two other points. If you haven't read it, Ms. Bowman issued, and the Fed issued a press release, I think, in the beginning of November 2025, attaching some supervisory principles about supervision. And the Fed has not gone on board yet with some of the stuff the OCC and the FDIC has done on unsafe and unsound. But there are a couple things I just wanted to highlight for you. One, examiners and other supervisory staff should prioritize their attention on the firm's material financial risks. That's consistent with what we've been talking about. Generally speaking, MRAs and MRIs should prioritize deficiencies that could have a material impact on the firm's financial condition rather than focusing on procedural documentation shortcomings we also just talked about. Examiners and other supervisory staff will no longer be permitted to communicate MRIs and MRIAs in vague or overbroad language. Instead, they will be required to communicate MRIs and MRIs with sufficient specificity so a person of ordinary intelligence, I don't know who they're insulting there, I don't know if that's me, of ordinary intelligence can readily know what the deficiency is. They should encourage meaningful dialogue and discussion between examiners and bank representatives. And to John's point, you know, why are we having to issue principles of some stuff that should have been pretty common sense approach? And then finally,
We are going to need a rule on regulation on defining ordinary intelligence.
yes, yeah, I agree with that, and NPR too. And then examiners and other supervisory staff need to change the way they decide whether enforcement actions, MRAs, should be terminated, because they're, you know, one of the things I talked about, the length of the exam cycle. You are seeing right now enforcement actions that are being lifted that have been in place 3, 4, 5, 6 years. That is not how the system was intended. So I think that these are positive developments. The question is, will they filter down to the examiners? And then the last point I want to make is this, that both the OCC and the FDIC have proposed expanded appeal rights. The Regal Act established an ombudsman program, I think in 1993 and 1994. There were very, very few appeals taken during the years and very few that were successful. The proposals say we want more appeals. We are encouraging more appeals. They're establishing an independent board made up of people with industry expertise, regulatory expertise. I think they're a 3-person panel. There is going to be a de novo review by these appeals. I think this could potentially turn the examination process upside down if more and more banks decide to avail themselves. And I think we're going to see that as a trend. So, you know, we're going to see fewer and more focused MRAs going forward. We're going to see less regulatory attention, as we said, on kind of non-financial risk. I think we're going to see fewer allegations of unsafe and unsound practices, particularly when it comes to things like policies and procedures. I think we're going to see fewer enforcement actions, which is bad for people like me, but potentially we'll see them and we'll potentially see them terminated earlier in the life cycle than we did in the past. And I think we're going to see more appeals. That may be a good thing for people like me.
Just a couple of practical observations, living and breathing this. So I think the whole notion of moving MRIs and MRAs to observations is too cute. I don't know of a single general counsel in this country that's going to advise their board, ignore that observation, right? So there may be some sort of collateral consequences technically, but as a practical matter, if your examiner makes an observation, you're going to follow that observation. That's point number one. Point number two, I also question the practical efficacy of an appeals process. Even currently, without a formal process, you do so at your peril. You're essentially telling your examiners who are coming in and day out, you got this wrong. And I think banks generally, general counsels, banks are going to be very reluctant to utilize an appeal process for the, just human sort of consequence of retribution. So I think we need to be mindful that these things may look good on paper, but as a practical matter, they may not be as effective as we think they are. And then the last thing that I will say is we really do need to focus even more so than in that statement that Mickey made about exiting. Under the guise of sustainability, can't speak about Eagle, I don't want to go to jail, but MRAs, MOUs are open for years after banks have remediated the deficiency because the examiners want to see sustainable remediation. So the Hotel California issue is critical, focus on the identification of these deficiencies, but also let's make sure we have common sense on closing out these matters that, as Meg knows all too well, have serious consequences for your CAMELS rating and then all sorts of strategic optionality.
All right, we're moving towards our world-famous donut networking session. But before we do, we want to open it up for questions from the audience.
Yes, I wanted to ask one question now. It relates to almost everyone's talks, but Richard's, especially early on the long time frame of some of the reviews. And IBM got its start way back in the 1870s because it was taking more than 10 years to tabulate the census, and they bought the little whole earth punch card company. So do you all think, or would anyone like to comment on the prospects of more real-time review or closer real-time review with AI and with some of the newer technologies?
I'm not sure that AI is there yet. I know we're going to have a panel on AI. It's going to have to get a lot more accurate. But I do think that the shift that Mickey has made on validation and letting an effective internal audit function do the validation instead of waiting for the supervisory staff to be able to do it, that's a nice practical change that I think will have a real impact. And then I want to just push back a little bit on the appeals process because I think I take your point, Paul, that most banks will be reluctant. I have advised banks where you do have an exam team that has gone off-piste. And so sometimes that can be made apparent to the regional directors. I also think that exam teams will think twice and will do better analysis if they know there's a real appeal process. So it can be a little bit, it can be effective while being like mom's best china, often looked at but hardly ever used.
Questions?
Yeah, thank you. First of all, thank you for putting this on, and thank you all for being here. It's nice to see many of you again. I wanted to share some news, and I was, Paul, your comment about deposit insurance reform made me think of something I heard yesterday. I heard Travis Hill speak, and he was talking about the FDIC's implementing regulations for stablecoins. And he made a very interesting comment. He brought up the issue of pass-through insurance and whether or not it would be available. And he said he did not think it should be because that would be inconsistent with the idea that stablecoins themselves were not FDIC insured. And I understand that, but it made me think that the eligible reserves for stablecoins are basically treasuries, deposits, and then repos backed by treasuries, mutual funds with treasuries, that sort of thing. So if I'm going to be a stablecoin issuer, and I'm going to look at where my money is going to go in reserves, the very last place I'm going to put it is in a bank, except maybe a too-big-to-fail bank, because the last thing you want to do, unless you want to insure a huge lawsuit against you, is to put any of your stablecoin reserves in a bank that might fail. So, any thoughts?
Can I, an alternative way of thinking about that is with all of the reciprocal deposit networks and all of the brokered deposits, and we now have, multiple enterprises who are offering, to chop up your deposits. And maybe, I don't know if it's AI or advanced computer programming, it could well be that those stablecoin reserves can be sprayed among, a multitude of community banks using reciprocal deposits and using, Promontory that's now IntraFi and Cali and ModFi and this Fi and that Fi. So none of us know how this is going to play out, but I'm not so sure that it will be only the too big to fail banks.
That's a fair point, Mike. Thanks.
One more question, but while he's walking up to the mic, I'd like to do a survey of the audience very quickly. How many of you out in the audience, and if you're online, one of the hundreds of so people watching online, you can raise your hand in your bedroom. How many people in the audience are dying to absolutely use stablecoins? Let me see a showing of hands. Well, there you have it. That's a very unsophisticated marketing review, but I think that tells you everything you need to know. Sir.
So my question is on the use of AI in regulatory exams and by regulators themselves. Along the lines JP asked, it can be used for monitoring and review. That's good. Regulators are also setting up some sandboxes to test the AI models themselves for banking purposes. What is the progress on that? And what's the risk which might be introduced, new risks which might be introduced due to AI?
Yeah, let me just speak to that very briefly before the panel does. I wrote something about the use of AI in regulation, and I thought I should give an example when I wrote it in my book. And the example I gave was when we closed 1,500 savings and loans, we needed 1,500 acquirers, right? How did we figure out who the acquirers were? Sat around a table and we spitballed it. Would it have worked better if we had an artificial intelligence program telling us who would create the best franchises, the most efficient network throughout this country on a long-term basis? Absolutely. Because all we were doing was guessing what made some sense for the FSLIC at that time and for banking in this country. But it was total guesswork. And I think had the regulators, had we had back then artificial intelligence that we could use not to make decisions but to help us, it would have been a whole different world. But speak to his question.
I can't speak to what the regulators are doing internally, but I think we have some regulators here later maybe, and so that's a good question for them. But there's like an emerging adage, which is there are sort of two kinds of workers. The workers who are learning how to incorporate AI into their work, and they will be successful at leveraging AI. And then there are the people who are not incorporating AI into their work, and they probably will not have work in 5 or 10 years. So I suspect the regulators, just like the banks and just like a lot of us, particularly those of us who are working, are trying to learn about AI and learn how to harness it to make our jobs, to make us more effective and our jobs more efficient.
Okay, well, this is the time you've held your applause till for this panel, which has been terrific. And so I'd like to thank them all and welcome you to our globally known networking session with donuts.